Ladies and gentlemen, it has come that time in which we will have our strategy meeting. If you're new to the service, this is where our trading team comes together and we provide a look at what we might expect over the coming weeks. And this might be the most important one that we've ever had since we've started Trader Audio. The reason being is that we have just a ton of catalysts in front of us. Let's start with earnings season. Then we got the elections. Then we have any policy updates that may come under that wing. And wow, it's just a lot. And I'm glad that we're able to get together and talk about what we might be seeing and bounce some ideas off each other. So, with that said, I'm going to toss out a question to Brett Manning, aka Chart Trader, and we're going to get things rolling here as the most prominent news so far today was that Nancy Pelosi threw some cold water on any stimulus talks. Now, I'm curious as to what you think where we are in terms of stimulus. We keep playing this love me not with the stimulus game. So, where are we with this? We did see a little bit of a downtick, Brett, after the Pelosi comments were out there. I would love to get your take on where we stand with that.
So, first of all, this is the most important strategy meeting ever, which means this is too much pressure for me, Jim. I don't know what to do.
Oh, Brett, you are not shy of pressure.
I'm gonna fold. No.
I you know what? I'll take I'm placing my bet on you, Brett.
All right. So, I think the main thing to appreciate, and we've talked about this throughout the year, it's been an extended process of a number of different high-level negotiations. And the negotiation process has, especially in politics or in the corporate boardroom or in, they're in mediation in a lawsuit, there are people around the table who are going to use words strategically, and it doesn't necessarily convey what they believe or what they intend. And that's the process of negotiating. So we faced this the other day with Trump, and I imagine we'll face it again, where you get an absolute declaration of something that is the case. The walking away from the table moment, the, okay, fine, forget it then. That moment is going to repeatedly happen. And I think that it could present some opportunities for short-term traders to understand that those words don't necessarily convey reality, that it's part of a strategy of positioning to influence the other side by manipulating perception of the situation. So I don't know where this is going to land. I don't pretend to know where this is going to land. But I would just caution people, when you see these headlines, in no way is that a face value statement. And so right now I'm short the S&P. I really kind of got a little bit lucky in terms of the timing of the Pelosi statement, but I don't think the entire dip that we saw was just Pelosi. I think we ran into some serious resistance, pretty much in the area I was looking for, at 34.30, 34.35. And we saw a ton of supply come in, and we saw a really robust bid hold despite all the supply coming in. Then her comments popped up. It helped the market dip a little bit. We tracked sideways for about 6 or 7 minutes, and then we started to hit the skid a little bit, go down the banana peel, as I like to call it, when we went through the sloped support, because that process, that resistance of people fighting for that territory, this is a really important level. It's the 61.8% fib of the bounce in the entire correction that we've seen here since September. So we had a lot of supply coming in. You've got a lot of leverage building up for people looking for that next breakout. So that secondary dip, I think, really was kind of cashing out some of the over-leveraged, overly short-term players. I'm not really optimistic on the position at this point, but that catalyst allowed it to set in motion a process. Now, there's probably a lot of people short the tape right in this area because that statement has come out, and it's very possible the next thing we'll hear will reflect the opposite sentiment. So you get caught in this washing machine of back and forth. That's why I call it the headline minefield. It's really tough to have conviction in this area. So I can't really answer your question where it's going to land. I'm just saying as a dynamic for traders, you're going to see a lot of headlines. They're going to move the market. People have been conditioned to pull the trigger, to get out of the way whenever anything starts moving. Whenever there's a headline with the name Pelosi in it, or Trump in it, or McConnell in it, or Meadows, a few other names. Whenever those names come out, people are going to quickly step out of the way because they don't know the extent that it's going to damage the tape, and they see that the tape is really reacting to these sorts of catalysts. It makes it really difficult to have conviction in any trade. And so I've been going a little bit lighter, a little bit more selective, and I would not worry so much about trying to handicap the outcome. Just be aware of the dynamic.
Well, part of the reason I asked, Brett, is because you're a big game theory guy, and I am always trying to figure out what the game theory is on these negotiations, particularly as there is a time clock here, right? And we keep talking about stimulus, and sometimes I try to figure out how is it even possible that we would be able to get stimulus out to the voting public in time, because if you remember last time, it took, I don't know, maybe about 6 weeks or so, and everyone got their check right around the April 15th deadline, but we had known about that a long time before that check was actually distributed to people. So now we're within a month of the election. I don't even know why they're even playing around with it or even toying with it. It doesn't seem like, from a logistics standpoint, that it would even be possible.
Well, you can get the promise out. People start spending and behaving as if the money's there. They'll shift the way that they're dealing with their household budget because, I mean, as long as you believe it's a credible process. I think that if a stimulus bill passes, we just went through this a few months ago. The promise was made. It took a while to get the money, but people got it, which means now the next time they get their paycheck, if they have a job, or whatever savings they have, or if they have a credit card and space on it, they're going to spend the stimulus check ahead of time. See what I'm saying? So that once you know the money's coming, it influences behavior, but also it influences sentiment. So I would assume, I think the expectation of a different landscape to your household budget associations over the coming, let's say, 2 to 3 months, that extra money is going to be there. That's going to take care of part of the mortgage bill or whatever, which means you can spend your next paycheck on, this, that, whatever. So I think that it still influences behavior ahead of time.
All right. Well, with that said, if they passed anything, and there was a change of regime, is there even the slightest possibility that they could revoke that? If they passed any stimulus?
Actually, that would be a good question for Carmine. One thing that I think is interesting and that a lot of people seem to be overlooking, except for Carmine, is that if Biden wins, the GOP doesn't lose a ton of seats in the Senate, they would be able to, in theory, scuttle any kind of fiscal stimulus after that. So you need 60 votes. There's no way that the Democrats are going to have 60 seats. If the Republicans go back into the mode they were in during Obama's second term, where basically you're just playing defense, this bill needs to pass now, or else there isn't going to be one. They're going to have to come up with a piecemeal way to do this. So I think that makes it extra important for the market.
All right, so there actually is some relevance out there, and I guess we just have to try to bob and weave the landmines that we get from these headlines. So, all right, Brett. So you're short right now. You don't have a ton of conviction in that one. I know you're getting pretty close. You're at the break-even point. So good thing you did take some profit off the table. It was a level that I liked actually as support too, right around the 34.20 zone. So good stuff there. All right. So why don't we open this conversation up, because I'm sure a lot of you have some insight. I want to throw this out there because we are not a political site. We don't have political opinions. All we are trying to do is understand what the market might be thinking about or baking into the action, and so this can get a little sensitive. Please don't take what we're saying out of context. Got to throw that disclaimer out there because it is important, and the closer we get to the elections, the more sensitive people are going to be. So I want to toss out the thoughts. Scott, you have a theory that pretty much no matter who wins, based on historical data points, that, other than some short-term volatility, it really doesn't matter who wins or loses. So given that, how are you playing this in the short term?
Yeah, that's a good point. So my whole premise is, I try to be as independent as possible when it comes to such diversity, amongst this sort of environment. And I look at everything from a large portfolio manager's perspective. Say you're in control of millions of dollars, even billions of dollars that are out there. Are you really making these, big investments, and you really putting your clients' money to work and at risk based upon an election? I think that's just extremely unwise money management and risk management, and I would pull my money from anybody that pushed that sort of agenda and said that that was their strategy on the market. Instead, if you look at any sort of academia and the history of successful portfolio managers, they try to keep everything independent, and what they do is they manage risk. And if you take the market at its core, the higher volatility is, the higher the uncertainty of the future is, the higher the risk. So I think it's safe to say that, since the last couple of weeks or months with the VIX, trading back above the $25 mark, a couple probes of the 30 mark, that volatility has been relatively higher than what we've been accustomed to. And again, that's coming off, a crash from March based upon the COVID virus spreading, the pandemic. But it's never really dropped back below 20. So volatility has been fairly high for a couple months now, but even more so over the last few weeks since September. So a few distribution days, and that's higher. That's signs of higher risk and higher volatility, a little bit less liquidity in the markets going on out there. Things are a little bit faster and looser by nature. And so as a large multi-billion, million-dollar portfolio manager, you're going to be cutting back. You're going to be cutting back on position sizes, share sizes, new trades. You're going to be hedging your portfolio to various degrees because there's all this extra volatility in the market. Now you're baking in, you're looking down the road to a few more weeks, and you can see that there's definitely uncertainty coming down the road, whether there's a defined decision made after November 3rd or not, or whether it just continues to draw out. It's continued uncertainty. And from a risk management standpoint, that basically puts everyone on the defensive. And again, I don't think it really matters. I think who wins. I think it matters when you have a decisive, answer eventually. Then money will pour back into the market, because now once all the uncertainty has subsided, then you would now be able to formulate a plan of action to take advantage of the new regime, of the new policies. And I think that you start to see money that has been sitting on the sideline come back into certain areas. Now, of course, different regimes, different political parties are going to have probably a bigger influence on certain sectors and industries when it comes to regulation, whether it's healthcare or energy or financials, etc. So there's going to be a more of a asset allocation rotation going on there once we find out which political party wins. But overall, I just think it's just the uncertainty that kind of just fits into the whole narrative here for the next few weeks, and it pays to be a little bit more short-term defensive. From a trading perspective, I know Gavin and I talk in the afternoons on Trader Audio, and we've constantly said over the last few weeks we've significantly cut back on our swing trading portfolios, not holding as many positions, and approach the market with more of a short-term tactical approach to just kind of making little trades here and there in the market and taking whatever we can get out of it. And that's really my overall plan for the next few weeks. I agree with Brett, everything he said there, especially with the headline minefield that is just absolutely, out there big time, with a lot of rhetoric from both sides that are just causing these intraday whipsaws in the market. So you just have to be really light on your toes, so to speak. I think the term that I used was trading on eggshells in the technical take comment. It's just a very delicate environment out there right now. And I think that's basically the best I can say. But I think come after November, once things have subsided, I think the uncertainty in the market is going to dissipate, and going into 2021, we should see some really good better swing trades, trending activity, good rotations, and everything else develop. I don't think it's going to be as crazy and hectic as the environment that we've seen the last couple of months here.
I'm going to throw this out to anyone, and I'm curious, what do you think the odds are that we get a end of the year FOMO type rally? We get the election out of the way, we get probably some news about vaccines, and then all of a sudden, boom, we get kind of that end of the year Santa rally that we see many times during the holiday season, late December. What do you think the odds of that happening are?
I could jump on this as event trader with my thoughts on this. I mean, there's so many variables in there, Jim. I mean, we got the elections. Do we get stimulus or not? Certainly, there is enough money out there from the Fed side of things that could transmit into a rally. But again, there's the stimulus, there's the election, there's the vaccine. So anybody could say they think we will, they think that we won't. But until we get a little bit more clarity on that, I think that's a very tough question to answer with any sort of strong belief one way or the other. I would say next week stands as a pretty important week, though. We got earnings season underway, and we've got the banks out. Now, the bank commentary from about a month ago was pretty positive in terms of the consumer spend, overall financial conditions, certainly a little bit of a slowdown on loan growth because of uncertainty for companies. But what I'm curious to hear is what they have to say has transpired over the last month as we've seen that fiscal stimulus wear off, particularly on the unemployment side of things. And is that having a major impact on spending habits as we go into the holiday season for the consumer? And I think that's going to be a real key story that we're going to need to watch. But I think everything's in place for a blow-off FOMO rally, but there's so many variables between now and then. I wouldn't be throwing all my money into the markets just yet with the idea that I'm going to make a killing here going into the end of the year. I want to see a couple of these questions answered before I did that.
This is Craig, Trend Tracker. I agree with everything that Scott and Gavin have kind of said, and I do think there is a potential for a big rally maybe once we do get past the election. It's kind of an overhang for now with all the uncertainty. But, I think that companies, like they usually have set the bar low enough so Q3 earnings largely will be a positive event. And then what do we have to look forward to? It's a much better 2021, and which is sort of dependent on the vaccine, but that expectation will be there. So as as uneven as this economy is, as many problems as we have, as stretched as the valuations are, I think the momentum trade to the upside might be able to continue, which is what I sort of implied at the end of my morning comment this morning.
Yes, it's Blue Chip here. I just want to jump in one more thing here.
Yeah, please.
And maybe Gavin and Brett can just elaborate on this because they do their sentiment and flow show recently. But I'm pretty sure that the overall consensus of the market and how it's going to perform is somewhat skewed to the negative side. I think investor confidence is not really strong. Based upon everything that's going on and whatnot. So I think it's very difficult to be bearish on a market that is trading near all-time highs and has such extreme sort of bearish sentiment going on there. Usually market tops form under more euphoric very overconfident, greedy, bullish sort of mentality and phase going on. And instead we have one of the most hated, stock market rallies, so to speak, that we've seen in a long, long time. So I think that's a little difficult. I don't know if Gavin or Brett, what were the latest readings overall, like on your sentiment and flow overall? Am I right in saying that things are still skewed towards more of a bearish tone, or are they flattening out a little bit?
So there's two sides to it. One of the things that we confronted here when we had our show is that the options data tells a very different story from all the other inputs.
Right.
The options data shows that there's more optimism, but we think that, at least I think that, and I think Gavin probably agrees based on our conversation, that there's kind of an apples to oranges historical comparison situation because there's so much more volume in the options market, and particularly among retail traders, that it's kind of becoming a substitute for shares in a lot of ways, and that's making the sort of hedging equations that you look for not really comparable to situations we've seen over the years. So it makes me want to sort of throw out that data as far as looking for raw market sentiment. And then I turn to everything else, and it kind of agrees with what you're saying for the most part. This is sort of a kind of classic wall of worry situation that keeps kind of moving up despite people not being really enthusiastic about where they think the market's going to be maybe 6 months in the future at any given time. And that would make sense given the sort of backdrop that we have. I mean, it's a recession and there's millions of people out of work and we've got a pandemic and we're heading toward a really contentious election. So there's a narrative backdrop to support the idea that it's not typically the type of time when you see people being super enthusiastic about the intermediate term future.
That's true, but here's a great point. So, hanging out with some friends and stuff like that recently, they bring up all those points, the pandemic, the high unemployment rate, et cetera, and yet the market's still trading within, 5 to 6, 10% of its all-time highs. So
21 trillion.
What's that? 21 trillion?
$21 trillion.
That's how much money's been put in.
$21 trillion.
Okay.
Has been created given birth in the world over the last 6 months.
Okay.
Right.
Okay. But even with that, again, from a technical sentiment standpoint, I'm just saying that, if we're not going down with all the garbage that's going on in this world right now, well, I'm really afraid to see what is actually going to take us down.
Well,
right.
Okay, but still, I'm agreeing with everything you're saying. I'm not arguing with you. I just want to.
Okay. Yeah, I know. I'm just kind of playing devil's advocate as well.
Yeah, and I mean the thing that I would add into this conversation is the idea that everyone is so low in sentiment really leads me to believe that we could get that blow-off FOMO top. Just some of the numbers that we were looking at from the fund manager survey. Now, it's a little dated here, and I'm going to bring in a new data point that we got today, too, into the conversation. But, whether or not it's a bull market or a bear bounce, that's gone way more in the direction of a bull market now at 58% of investors. Most no longer see a recession at this time, which was the first time since February that more investors saw this as the early part of a new phase to the upside than a recession. So that was important. The idea of escape velocity is still certainly low, as 61% predict this is a U-shaped recovery, as opposed to 20% saying that it was a V-shaped recovery. Now, that I don't understand because I think we kind of had the answer on that already, that it was a V-shaped recovery. One of the interesting items that we came across was the dry powder, which actually rose to 4.8%, which is still below the 5% threshold that Bank of America uses as that being fear, but still a lot of money that could be put into play here. And I guess one of the things that I would note for one of the interesting items of this was 41% of people look at vaccines as being the biggest cause for why we could see an increase in rates. Now, that would give a little bit more credence to the idea that we could have a stronger, longer-term economic standpoint. So vaccines still sit at the top of what's going to be really driving the markets here. And we've got some positive data points on that. Whether or not we'll get it fast enough remains to be seen. But, if we do start seeing more improved data points there, then that that's going to certainly be a key driver, especially once we get past the elections. And again, there's the idea of financial stability in the markets. As Craig pointed out, all these levels have been dropped so low in terms of consensus expectations that we should see beats. The bigger item is going to be, what are we going to see on the guidance front? Are we going to get more of a Micron type outlook, or a little bit more of an improved outlook from these companies? And that's all going to factor in. But one thing that I did strike my attention this morning that I'd be curious to throw out to the group, the AAII sentiment survey this morning came out at 800 basis point pop in the bullish side. It went from 26.2% to 34.7%. The bears dropped from 43% to 38.97%. Neutral dropped from 30% to 26%. So a big pop there. This is the highest bull survey we've seen since June 4th. Of course, in June, that is when we saw a little bit of a rollover go as we started entering the earnings season. We had that one drop back on June 11th. I'd be curious as to what people think about this new bull reading here.
Well, I would like you to me, it's obvious what accounts for that, but I'm curious if I'm crazy. What do you think has changed in the last week?
I mean, not to get political again, I think the idea that perhaps there's a little bit more clarity around the elections, and
yes, we're not going to find out the winner in March, or at least it seems that way now, versus how things seemed a few weeks ago.
And again, not a political show, just reading and interpreting the data that we're seeing here. So
market hates uncertainty.
Exactly, and this helps maybe provide a little bit more certainty. So that was my take on it, and I'd be curious. But how do people view this recent rally in the market? I've seen plenty of mention around an ABC part of the dip on an Elliott wave that we're now seeing the recovery D part. I'd be curious to Scott's theory on that, and then on this bullish sentiment too from the traders.
Yeah, I'm not the biggest Elliott wave guy in the world, but I could see what's happening there. I know, basically, if you're not familiar with it, Elliott wave just says the market moves in thrusts and retracements. So basically, it's trending modes and then a pullback in simple terms. And so if you look at the market, there has been a really strong thrust if you look back in like August, and then we peaked down in September, and then there was one leg down off the September peak, bounced off the 50-day moving averages in the SPY there, or the S&P, and then after bouncing a little bit, there was another leg down below the 50-day moving averages, which brought us underneath the August lows there, around 320 in the SPY. And that is basically considered to be like a one leg down, a two leg pullback, and then a third leg down, or ABC. And zigzag, thank you. And then, so then that's in a bull cycle, which is really what we've been in over the last couple of months. And if you look at a bigger picture, yearly cycle, that is just kind of a typical Elliott wave sort of ABC corrective move that can lead to a stronger trend higher, stronger thrust higher, probably back to the highs a little higher. But going back to the original question, why do I think AAII sentiment surveys improved a little bit? First of all, I've watched this a lot over the last couple of years, AAII. It's a very fickle group of people that they survey, in my opinion. I noticed that they're very short-term oriented, even though they ask them what their outlook is for the next 6 months in the survey. It seems to be fluctuate strongly based upon whatever the market's doing over the last week. And the one thing I would say, based upon that, small caps have had a very strong performance the last 2 weeks or so. So have mid caps. In fact, IWM and MDY have both surpassed the August and September highs, unlike their larger cap peers, the NASDAQ, the Dow, and the S&P. I also track the cumulative advanced decline line on the New York Stock Exchange, and believe it or not, that is actually breaking out to fresh all-time highs this week. So the technical case here could be that there's actually a very strong, I would call it almost a stealth bull market that is very well underway at this point in time. So I am thinking between the combination of seeing small caps and mid caps, surpass these resistance levels and showing some strength here, showing that there's money being put to work in other areas of the market, and seeing overall breadth improve here. I could see why that sentiment has been, ticking up a little bit.
All right, gentlemen. Now, one thing we haven't even really touched on is the fact that earnings season starts next week, and we kick things off with the financials. And I'm curious, I am in the camp that thinks that we may be poised to see a nice set of earnings from the financials, maybe not so much from the earnings standpoint, but maybe from the outlook, considering what we've seen in the yield curve, and that's going to have an impact on the net interest margin. So maybe kind of the forward-looking commentary might be what they are focusing on. So I'd love to get your thoughts if maybe that might be what we will see for the beginning of earnings season, and then how will some of the pre-announcements that we've seen that have blown away numbers, how is that going to play out? Are we going to get to a point where the estimates really don't matter and it's going to be a lot more about the forward commentary?
Event trader. For earnings for banks next week, I do think that we are going to see some solid earnings and is concerned against consensus. I urge everybody to go back to my September 15th commentary, where we were getting a lot of guidance and outlook from the banks going into this Q3 earnings to see kind of what the themes are. Stronger investment banking, a little bit lower on the revenue side, and net interest income, and margins as well. And then, of course, provisions are going to be a big part. Provisions is going to be how people are going to read how the banks are seeing the economy and whether or not they're seeing an uptick in credit concerns. And that's going to be the biggest issue for people moving forward. For me, as Craig said, everything's been lowered so much with the consensus numbers that I think there's going to be a lot more thrown in on the outlook than there is going to be on these current results. But two of the more interesting things that I've seen so far has been Wingstop and Domino's Pizza results, where we've seen sell the news reaction of both of these. So I'm kind of curious as to see if that continues to play out moving forward.
Yeah, Gavin, and I'm curious to see if that same sentiment might kick into the semiconductor space, because time after time we keep seeing better than expected results as far as pre-announcements, and we talked about Samsung and Taiwan Semiconductor posting better than expected results. So far, the market has responded accordingly. It's trading higher, but this may not be the case once we get into the thick of earnings season and some of those other tech names roll out with their earnings. I guess it wasn't really a question there per se. It was just more an observation that I think that same sentiment may kick in.
Yeah, we've seen positive pre-announcements from Alteryx, AYX, and Twilio in the software group over the last week, and they both responded favorably. I think it's kind of more of a case-by-case kind of basis, a stock-specific thing. It might not be as easy to generalize, whether or not we'll get a bunch of broader sell the news reactions. Something like Zoom that has just had a massive run, probably going to have another great report. I mean, that's a tough one. Could go either way. I guess my bias would be on the short side on that one, because it's already at an extreme valuation. It's already had a massive run. We all know that it's going to be another great report. Where something like Alteryx had guided down, so it was kind of more due for a bounce on a strong report. So I don't know. I think it's mostly a stock-specific basis that I'll kind of approach things, which is pretty typical, I guess.
Hi, gentlemen. This is Scout. Question for you. want to get some just your thoughts on just kind of observations you've been making just about the world, or the world around you, and if there are any investment opportunities based on these experiences. For example, I've noticed in the Chicago area, when I go out now, there are a ton of people out. I mean, an absolute ton. Everyone's wearing masks. Target parking lot is full. The grocery store parking lot is full. Strip centers, people are going back to get haircuts and going to the Jenny Craig place and going to Petco, and so people are starting to get back to life. I go to the gym, people are in the gym, and so for that reason, I've started to turn more bullish on REITs, and I'm starting to research like some hotel plays, and you're starting to, as Trump in Trump's video last night, he says the drug he took from Regeneron is like a miracle cure, and we're getting close to having, additional therapeutics and vaccines. And so, based on kind of what we're seeing and where there might be potentially remaining value or new trends, are you guys seeing anything that might make for interesting investment opportunities?
This is an event trader here. I'd agree with that. And Carmine had sent me out a data, and it looked like it was legitimate. But there's been 70,000 COVID cases from universities, and there's been a total of 3 hospitalizations and no deaths. Now, obviously, everyone's going to say, well, they could go back.
Can you repeat that?
There was 70,000 COVID cases from universities.
Wait, yesterday, over the 2 weeks, over a month, what's the...
This has been over the last month, I believe. I'm not sure the exact date.
Yeah, right. Okay.
Like
no, that makes sense.
He sent it off, and then I asked him where he got the data from, and he followed up. I don't have it in front of me, but it was a number that jumped out. 70,000 COVID infections in universities, 3 hospitalizations, and 0 deaths. And I know, Brett, you had in your report this morning the drop in hospitalizations and deaths also being a key issue. So I do think that people are learning to live with it, as Damon is saying, and that's certainly something that needs to be paid attention to. And the REITs would certainly be of interest in that aspect. But I guess the thing that I'm seeing the most interested in, and we've been banging this home on the site, is really the infrastructure plays getting underway. The Martin Marietta, MLM, Vulcan Materials, VMC is breaking out here. I took the long and that IFRA, infrastructure REIT, that's attempting to break out. And that's the one thing that I'm seeing a lot of as I'm going through my searches, the idea that we could get infrastructure on top of everything, some sort of fiscal policy on top of everything else that will lead to more infrastructure plans going on and building up and putting people back to work is an aspect of the economy. So there is that. And the other thing that I've been seeing a lot of is these beaten down banks, the KRE. When I was going through looking at next week's earnings, USB, PNC, all these charts are really starting to look good, starting to build off bottoms. And that would all point to Damon's thought that, people are getting a little bit more, used to living with this and finding ways around it that, could give us that escape velocity that we're looking for, and that blow off top question that Jim was talking about earlier. That's the one thing that I'm noticing.
Hey guys, this is Chart Trader, and I could follow up just with a brief thought, which is I agree with the perspective Damon has. I've been seeing basically the same reality, and I think that people are getting better at dealing with it, and it's getting slightly easier to deal with, and there's more tools coming in to better deal with it. And all of those things are increasing every day. In my notes this morning, I called it relative less awfulness. Basically, you have awful, and if it gets slightly less awful every day, that's an improvement, even though you can still manage to construct a narrative that the world is a rough place. But market's going to worry about the relative change, and I think unquestionably that Damon is correct, that we're moving toward relative less awfulness through relative less awfulness, maybe lower virulence, maybe better tools, maybe smarter behaviors, and then a vaccine is coming at some point. One thing that I would point to, something we talked about before, would be oil, which is just basically you still don't have producers willing to commit on a fixed cost level to really sizably ramp up production. And if Damon's perspective is correct, if this is the thing that we're seeing, that puts back in play something that we talked about over the summer, which is basically a big squeeze higher in oil, maybe above the 50 level.
Yeah, I would note that I generally agree. We're all adapting and things are slowly going back to normal. A lot of the points that Brett hit on this morning are very relevant. We're all kind of getting used to it, but we're getting used to this different world. So I think one of the key stocks to own right now based on this world that we are living in is this Fulgent FLGT, which is a testing company. So, unfortunately, it is widespread, so testing isn't going away anytime soon. Eventually, this stock is going to set up for a good short, just like Zoom, presumably. But it's hard to believe that is going to be anytime soon. I mean, this winter is going to be a period where testing is going to be it's just going to be a part of everyone's lives. It's not going away. So I think, it's possible that we do see a sell the news because everybody knows they're going to have a huge Q3 when they report next. So yes, a sell the news is possible. Obviously we're making advancements in testing technologies, but this company is still well positioned and is still going to have at least another quarter or two or three of strong results. So, there's a small float here, so I still think it's a good one to own at this juncture. The chart looks pretty damn good right now too, putting in higher lows after that washout in September. And then the other one that I would say is a good buy for the eventual improvement and into next year is Lyft, which is trading at a dirt cheap valuation. I think the enterprise value is like $7 billion. It's trading at 2 times sales. Ride sharing is not going away. I think this is a great time to get in for longer term investors. A great way to play both the cyclical recovery, a return to normalcy, and the secular growth in ride sharing.
Gavin, I think you had a question for Damon regarding the REITs.
Yeah, I'm sorry, Damon. Did you want to jump in after Craig first? Did you have?
Oh, sorry, I was muted. So I wanted to jump back to an article that I highlighted yesterday in my morning comment, Bloomberg article talking about the robust recovery in China and just domestic travel travel industry. Hotel prices are up 20-30% year over year. Airline prices are higher just because of the robust demand. People aren't really going outside of the country, but they're traveling a great deal with inside the country. So I think that could be a preview of what we're looking at in 2021. I know there was a question about some of the names that I'm looking at. So from a REIT perspective, so one of the names that looks interesting to me is American Campus Communities, ACC, which owns college apartment buildings, essentially. So, I think that I think, first of all, people are a little bit more comfortable just given the numbers, with respect to the hospitalizations of college students. I think they'll become increasingly more comfortable sending their kids to school, but they might want to have more spacing. They might not want their kids in 2,000 person dorm and might be willing to pay up a little bit more to live in off-campus apartments, luxury off-campus apartments at that. So that's a name that's a little bit beaten down. It's been starting to bounce recently. Another name I've been looking at is Chatham Hotels, or CLDT, Chatham Lodging, Charlie, Larry, David, Tom. And they own extended stay hotels basically in the suburbs. So, people are traveling for, like, I know in our family, we travel for different tournaments, lacrosse tournaments, and people in neighborhood baseball tournaments and softball tournaments, soccer tournaments. And, and people have just been jumping in their cars and driving to within a couple states over and feeling a little bit relatively comfortable staying in the extended stay hotels where, a lot of times you have direct access to your room. You don't have to go inside of a primary building to get to your actual room. Some of them you do, but those types of hotels have done really well relative to obviously large urban hotels that rely a lot on conference business. So then I kind of wanted to jump back to energy. So yesterday I put out a comment. Someone asked me about why I haven't been recommending more MLPs, energy MLPs. And my point was that I kind of view this as almost like a once in a generation opportunity to buy REITs. And the benefits of that are, one, they're really beaten down, and there's an opportunity to buy names with yields, double-digit yields currently, and that's already with reduced distributions or dividends. So a lot of these REITs have reduced their dividends, and they're still yielding 10, 11, 12%. So as things come back, they'll increase their dividends again. And the thing you have to understand about a REIT is, in order to qualify as a REIT, you have to pay out, I think, 90% of your income. So it's not like they can kind of hold back and save it for a rainy day. Basically income determines how much they pay. So a lot of these dividends that come back pretty quickly. The other benefit of REITs versus MLPs is that a lot of MLPs come with K1s. And so the structure of them kind of prohibit them from being held in tax protected accounts like a Roth or 401k, whereas a REIT you can put into one of those tax sheltered accounts. So essentially you don't have to pay taxes on it. So that's a nice benefit. So effectively boosts the yield. And I mean, so six months ago or a year ago, an attractive MLP might be yielding 8 to 12%, 12% more on the speculative end. I mean, you can buy a very attractive REIT that's yielding 12 to 15%. So I think the risk is less with a REIT. But the other point that I was making with MLPs was that I just don't, obviously, if Biden Harris wins the White House, that ticket wins the White House, obviously they're not as bullish on the energy economy as Trump. Trump basically joined OPEC, put the United States into OPEC in order to kind of support energy prices. That's not something Biden will do. However, I'm starting to think a little bit more. I mean, like last night, for example, Pence presented the comment to Harris that basically she said that she wanted to ban fracking, and she denied it. And I think that actually has a lot to do with, well, it's benefiting energy prices somewhat today, or energy names. She's seeing a very strong rally in energy names because she basically backed down from any idea of banning fracking. However, I don't think this administration, should they be elected, would be real friends of the energy industry. And so I guess the question I ask is that a benefit to energy, right? Like if you have some people who are prevented from doing some of the more aggressive drilling, and you have the White House potentially not supporting certain aspects of, whether it be lawsuits or different things that the White House or the government may have control over, does that potentially limit energy supply, thus boost the overall price? And I know Brett covers energy a bit in terms of the trading and the game theory. So maybe you want to jump in there on that question, Brett.
Yeah, I think you're absolutely correct. I think that if you put in place a regime that punishes the individual companies, makes it harder for them to produce supply, you're unquestionably going to increase the price. Like, it's a really simple calculation to make, and I don't think that there's. I think that Trump played both sides of it. First of all, in terms of his relationship with OPEC, if energy prices got high, he was not working to support the price, right? So he was really active. I think the new administration would be far less active in general, so it would be more about what is OPEC going to do, generally speaking, and probably, just less interventionist in every single possible way internationally. So, what does OPEC want to do? Well, they certainly want the price above its current levels, and if you don't have intervention on either side, it's more about what OPEC wants. And again, you're right. If you're then taking the United States is now the biggest oil producer in the world. If our policies are limiting the production of the United States in terms of our energy products, then yeah. So you've got both sides of that equation leading to higher energy prices.
Well, this is timely. The WSJ is reporting that Saudi Arabia is considering canceling OPEC plans to hike outputs next year. Any thought on that?
There you go.
All right. So let's see. As far as I have a question for you, Damon, and that's it with regards to REITs. And I think there's a little bit of a conundrum out there because I seem to read a lot of stories and articles of real world people still struggling to pay rent, struggling to figure out, hey, if there's no stimulus or if there's not a help for some small businesses, they're going to go out of business. People, some of that forbearance, like in my circle, some people were just delaying their rent payment and they still got to pay that. Whoever the landlord is, the mortgage is still due, and that's actually going to come up at some point, right? I mean, after we get past this election, we're still going to have a very high unemployment rate. We're still going to have people struggling. So I wonder where that bakes into your REIT thesis.
Well, and so there are certain REITs that I'm avoiding. I'm not a real fan of office REITs. I'm not a huge fan of most shopping REITs, retail REITs. Certain names that have like high exposure to sit-down restaurants, for example. So I spent a lot of time kind of going through and looking at the actual business model of a bunch of these companies. And so I think last strategy meeting, I highlighted two: Redwood Trust, RWT, which basically makes loans, mortgage loans. And so obviously the mortgage market, refi market is just through the roof. I mean, absolutely, people are printing money there. They do loan servicing. Well, in the sense they package loans and sell them into the secondary market. Still big spreads on non-conforming loans, which is what Redwood Trust focuses on. Their other business is business purpose loans. So they actually do a lot of lending to developers of single family rentals, which again is a business that is going gangbusters right now. People wanting to move out of cities and live in their own space, their own single family home. So you actually have companies building, so some of these private equity firms or even the publicly traded firms, single family REITs, they are actually having entire single family rental communities being built for them. I mean, the demand is just off the charts, and you can see by the home builder stocks are, trading, have been trading extremely well. So I think it's a matter of making sure you target the type of name that really can benefit from this economy, this recovery. Another name that I highlighted was Ladder Capital, LADR, which makes loans to basically private equity firms that are trying to develop properties. Their loan to values are about 60%, 65%. So there's a lot of cushion there, right? And this is also a company that doesn't mind taking a property back and running it to maximize return. So if you have someone who basically put 35% down on a property, say $100 million mixed use redevelopment, they don't want to put any more money into it. Maybe they're out of money. Ladder will take it back, develop it, run it, and maybe sell it 2 or 3 years later. And I mean, they've had a great track record of doing this type of thing. So, I mean, that's an opportunity to kind of invest in the sharks, the people who are out there, looking at deals and understanding, finding compelling distressed opportunities. And, you're getting a double-digit yield on it. We've done really well. I think we bought it like in the 3s or the 4s or something like that. It's trading about 760 right now. I still like it. The other thing is that the spreads on the loans that these companies can make are really compelling. I mean, like 6-7 months ago, they were, fighting each other for business, right? There's just so much capital out there to make these loans. A lot of that capital is dried up. A lot of that capital got lost due to margin calls in March and April. And banks are not willing to extend that margin to these lenders anymore. And so companies that have really strong balance sheets like Ladder, which I think has basically $700 or $800 million in cash just sitting around on its balance sheet right now. I mean, I was on a conference call. I may have mentioned this before. I was on a conference call last month, and it was a hotel company that was doing a redevelop. Well, they were finishing up a new build, and they couldn't get money from anywhere. They literally had to borrow money at like 8% on something that, was essentially already built. They just had like a few more things to add to it, which is, I think probably 6 or 7 months ago, that loan probably would have been more like 4%, 4.5%. And, interest rates have actually gone down substantially since then. So I guess my point is that if a company like Ladder can borrow money at 2% and lend it out at 7-8%, just, ridiculous spreads. And so they're structured as a REIT, though, even though they're essentially a financial services company, they're structured as a REIT. So a lot of different types of REIT opportunities out there that aren't just your kind of plain vanilla apartments or office space.
All right, so all REITs are not created equal. Be very selective in diving into that. I want to toss one idea out to you where you've been talking about how the home builders have been strong, and it seems like that strength is really prevailing. I have a friend who does mortgage closings and just always busy, 12-hour days, always looking for new help. And what caught my attention was this lumber chart. Now, probably you guys don't pay much attention to lumber. Maybe Chart Trader does, and that's your little prep there, chart, to take a look at this lumber chart. It's come back into a compelling level. But also, if you think about it, I don't exactly know the hedging process that they use, but it has come back into a pretty nice level. That could actually help the home building markets and the stocks themselves. So love to get your thoughts on lumber a little bit.
You're asking me?
Yes, if you don't mind.
Well, I don't really have any coherent and cohesive thoughts on lumber as a market. It's not one of the markets that I focus on.
Ever? So, really? I'm surprised.
Yeah. No, well, I mean, I have my home field markets. I have got a range of commodity markets and the sort of cross macro markets that everybody follows is trading from a macro perspective. And then when you get into things like lumber or milk futures or orange juice or coffee or something like that, now lumber just as an indicator, I mean, it's interesting to see, and we saw this months and months ago that the strength started to really take off. And I think that there's a supply issue there, maybe more than anything else. But then when you pin interest rates where they are, and yeah, I mean, you're starting to, as you said, you're starting to see, and I think that there's also a process of just, do you buy an existing home that was built in 1992, or do you buy a lot and you knock down a home and you build a new house? Because there's been a tremendously rapid evolution of building methodologies over the last couple of decades. So I think that's part of what's happening is it's cheaper to build a better house. And a lot of people are just simply building new houses rather rather than, living in existing structures. But yeah, I mean, there's no question it's an interesting phenomenon as a market indicator, but I don't study it closely the way that I do something like crude oil or even copper on the commodity side.
Yeah, I don't follow it either, Jim, but just as a heads up, and kind of combine the lumber story with Damon's REITs. In my personal account, I had bought some Weyerhaeuser, ticker symbol WY. It's looking good. This is a timber REIT that, that could be something that some people want to take a look at. Ryoneer, RYN, is another play on that, but I don't have too much to say on the lumber market myself either. Outside of that WY, I do own in my personal.
Well, and then part of the reason why I brought it up is, last I checked, the California fires are still wreaking havoc. I don't know how much of supply that the Weyerhaeusers of the world get from over there, but you would think that there's got to be some supply that might be running out. I don't know. I'm not all that studied up on lumber itself, but I do think that the chart looks somewhat compelling. So at least wanted to toss out something that we don't normally talk about. So I do appreciate the commentary nonetheless. All right, gentlemen. Go ahead.
Jim, there is two lumber ETFs. I don't know if anybody is interested, but there's a Wood, WOOD, and CUT, CUT. Neither of them really trade a ton.
Is CUT the inverse one, Craig, out of curiosity?
I don't think so.
No? Okay.
I don't think so. It would be
missed opportunity.
Yeah. But just glancing at the holdings, it's the stocks that you mentioned, forest, what do you call them, timber producers. That Weyerhaeuser, I think, is one of the big holdings in both of them. So, there's a diversified way to play it in the ETF space, but I really don't have an opinion on it either. If lumber prices continue to go up, it's like an incremental headwind to home builder margins. But obviously, if the housing market is on fire, then it's not a huge concern. So.
Hey guys, I wanted to jump in one more time because I think this is kind of a big issue, long-term issue that may impact our subscribers as well. So when I talk to people in their 20s and 30s about the market over the past 6 to 9 months, and they say, oh, wow, this has been interesting. They've been very engaged, maybe hadn't really paid attention to it before, but they were at home, a lot of buzz about equities, and maybe they opened their account for the first time. And when I talk to people above 50, like they're constantly asking me, like, what the hell is going on? Like, I moved to the sideline. I don't understand this market. I'm in cash. Why is it going up? And I think the reality is that, when you get to 2021, you're going to see that a lot of people have a lot of cash in the mattress and they're going to be desperate for income. And I pointed out yesterday that we were seeing preferred stocks make 52-week high. If you looked at the 52-week high list yesterday, it was dominated by preferred stocks, and yields being bid down to below 4% in many cases, stocks trading 10 to 15% above par. So I think that could be a 2021 story. The desperation to basically have your money work for you with yields where they are. And so that's another reason I'm bullish on REITs, just because people will essentially overpay to get some type of income, some type of return there that they consider relatively safe. You guys have any thoughts on that? Just kind of, what type of assets might get bid up and that desperation for yield, and just any general thoughts on that idea?
I could chime in with a general thought that's not necessarily saying which assets will be bid up, but just to reinforce your point, that's going to be a very competitive theme too, because you've got we're back in a situation where you've got the refugees from the bond market because you've got dividend yields well above the 10-year. And anytime you get to that situation, you've got a lot of people, and you've also going to have an increasing problem with things like pension funds and endowment funds that have been counting on some kind of really long-term process where they could use fixed income securities to meet future liabilities. And it's just stacking up, and it's getting worse and worse and worse. And Damon, I'm sure you understand the situation that the state of Illinois is in terms of its pension funds. So that was based on a calculation, a decade or two ago about where there would be a risk-free rate of return. And what we've seen over the last decade, and has now intensified a lot this year, is that there's no chance to get anything like a return that would keep you on course for that. So all those investments are migrating out, trying to compete for the same thing, which further puts pressure on exactly the same assets that you're talking about.
Looks like Trend Tracker, you just went out with a new one, Trend. Shorting Workhouse?
Yeah,
Workhorse?
yeah, Workhorse. This is a stock that I really don't know intimately, but seems to be kind of picked up in the whole EV bubble that sort of formed in the wake of Tesla's surge. I'll have to dig into this one a little bit closer, but it kind of looked like it was going to break down here intraday, so I just gave it enough room with the stop in case it doesn't really make its move here. But just a quick glance, it's trading at like 35 times sales. There was a short report on it this morning. It dumped and then kind of came right back. But there is a pretty big float here. Obviously, there's going to be some squeeze risk here. But I mean, I had always kind of assumed this thing was junk, to be honest. So I don't know. I just kind of like this opportunity here.
All right. So is there any other commentary, any parting shots we got to throw out there as we've kind of really covered a lot of ground? Is there anything else that we might have left out?
Yeah, I just want to follow up with three things here real fast. We'll try to make it fast. First, with regards to Damon, as we mentioned before, the amount of money on the sidelines, Bank of America noted, had gone up. I've seen the figure of $5 trillion on the sidelines, so I'd agree with Damon there. In terms of where it's allocated to, I guess, Damon, it's going to kind of have to depend on who's got the money on the sidelines, right? I would see a younger investor chasing after the tech space, where if it's somebody older that took their money out, not liking the risk that was out there, they're probably going to be looking for something a little bit safer and going after the value plays. So, I could see that being a broad push higher on the asset classes, depending on where that money on the sidelines is coming from, would be my response. I certainly like the looks of a lot of these banks, but admittedly, they're looking a little bit more like utilities and probably wouldn't be as attractive under a Democratic blue wave sweep just because of regulation, at least in the immediate term anyway. And whether or not this has already been priced in, that's something that we're definitely going to want to watch after November if we do indeed get a blue sweep. So that's one area that I'm looking at. And, of course, again, the infrastructure plays that I've been mentioning. The second thing that I wanted to throw out to you guys was the idea of, has anybody, and I asked Jim about this, has anybody bought puts on an M&A name? In particular, I'm looking at Eaton Vance, and just under the idea that would this deal be able to go through if we did see a blue sweep? And I was curious if anybody's dabbled with buying puts on expectations of an M&A deal to fall through.
Let me just get my first thing out of the way and then back to Gavin's question. But on Damon's point, even over a longer time horizon, I saw a Morgan Stanley report looking at the next decade. And I don't know where this fits in your head, Damon, but apparently the amount of money that's supposed to be transferred intergenerationally through inheritance going to millennials and younger investors over the next 10 years is $68 trillion. So you can imagine that cash on the sidelines is actually going through a gradual process of transferring.
Wow.
Which is really, really shifting in terms of who's going to control the major wealth of the world.
Well, I'm Tesla then, huh?
I was going to say the same thing.
Right. Well, with that too, we have to see about the tax system, right? If they're going to broadly tax wealth, isn't that one of the things that Biden wants to push in? Does anybody know?
I don't.
Okay.
All right, Craig. So you have one more comment?
Yeah, I just wanted to bring up the stock that I have been kind of fawning over recently, GoodRx, a recent IPO. I was big on it ever since I read the S1 the first time, like a month or two ago, and it sort of does fit into a broader theme of Damon's question from like 20 minutes ago about, this is they do a lot of advertising, but it's still not a company or stock that a lot of people are going to be familiar with, and it addresses one of the biggest problems in this country. I just wanted to note that I think the quiet period is going to end not next week, but the week after, which means we'll have some low-ball sell-side estimates in place, likely when the company reports its Q3 numbers. And the company did see a pretty significant slowdown in Q2 as a result of the, everybody being locked down, what I refer to as like a decrease in utilization in the healthcare industry, right? People were not going to the doctor as much, not getting as many prescriptions. I think there's a long runway here in terms of awareness for consumers. There is a lot of, regulatory risk here because it's such a convoluted space. Congress and the White House, continually pledges to try and fix this issue that we have with drug prices. It seems unlikely that they will ever make any headway. If Obamacare gets shot down, then that would be bullish because there'd be more of a need. Obviously, some kind of legislation after a potential blue wave could possibly hurt them, but this stock just it almost seems like too good to be true, which I hate to even say that, but the stock is already trading at a premium valuation, but the Q3 should see a nice bounce back in their growth rate if there was that pent-up demand like we have seen with a lot of other healthcare companies where because things have normalized. So I like the setup here. It got up to 64 on that one day. The setup on the chart is looking pretty good. This is probably one of my favorite stocks in the market right now, despite the frothy valuation. So it's one to keep on your radar, either to own or it does move pretty good. It's pretty volatile, so it's one to keep on your radar.
And that's
as well.
And that's GDRX.
Yes, GoodRX, GDRX.
All right, GDRX. All right. Anything else from you guys?
Yeah, did anybody have an answer on that question on the EVs in terms of just broadly trying to buy puts on M&A activity? Has anybody done it?
I've never tried to do that. No. If there was a reason to believe that a specific deal would fall apart, maybe, but I don't know, I feel like you'd have to have some kind of real insight into a specific deal. I guess my short answer is no.
Okay.
Yeah, I would say the same. I look at these. Look at a lot of deals. Typically the ones that the hedgers, the R people are skeptical of, will trade at a somewhat meaningful discount to the value of the deal. So I think that's probably your biggest clue that there is a potential for the deal not to go through. Say something that's trading at a plus 5% discount to the takeover value versus closer to a 2. And I'm not sure if this is a cash deal or a stock deal. Obviously, we get
half cash, half stock, but there's going to be a vote on it.
Okay, so you get a little bit more of a discount if stock is involved versus cash. But yeah, that would be the first thing I look at to see how much of a discount is priced into the deal, which will kind of give you a sense of the level of skepticism by professional arbitrage firms.
So, Gavin, is there a reason you think that this deal might fall apart, or you think that investors don't want it? Or
if we get that blue wave, I think that we could see it being brought under a spotlight. We saw the review on the tech companies here, and financials have certainly been an area, especially if we go to Elizabeth Warren with a prime seat in the administration. It's just a thought of buying something as a lottery ticket for out in the middle of 2021. I could see this deal coming under scrutiny, though, is probably the bottom line.
Gotcha. Yeah, one where. Sorry, go ahead, Damon.
Yeah, I just wanted, yeah, so why? Like, I just want to, because this is kind of off my radar in terms of, was Eaton Vance money management firm?
Yeah.
Okay, so why would there be scrutiny associated with it? I just want to kind of get your thinking on it.
Just financials in general. I mean, Morgan Stanley is, I would have to double check on the size, but we know it's in the G-SIFI group. So, right there, it's going to be brought into question. We're seeing the size of these banks going up because of all the payment protection or the payroll protection plans going out. A lot of people are taking this money and they're putting it directly into their accounts and into their savings accounts for a rainy day, which is probably the right move. But what you're going to see is a key theme coming up in this upcoming earnings season is banks are going to have to store away more capital in order to meet the requirements of their buffers that they will need due to their size. So they are going to raise up in total asset value because everyone's taking that money and putting it into their deposits. It's also going to cost them in on the deposit costs, which will be something that will impact earnings coming around. But the bigger item is just overall sizes are going to increase. And when you're seeing somebody add in an asset manager under there, that's going to be just more size, more assets under management, more regulatory scrutiny. We just saw the deal coming out with Citigroup, where Citigroup got fined $400 million. JP Morgan recently just got fined by the SEC for its commodity trading practices. And the idea of more regulation coming around the banks is certainly going to be very much in the at the forefront if we did see a blue wave, in which case I think that any M&A activity that's going to go in through 2021 is going to be put into question. And I think that we could see that play out in the Eaton Vance Morgan Stanley merger. That's my theory on it. But what I don't know is if I should be going in and just trying to buy a put for the middle of 2021 is kind of what I'm bouncing around and kicking around the idea.
Yeah, I mean, if you wait, I mean, you probably don't want to do it today, but I mean, if you think that's a possibility, and maybe wait a week or so and get something far out that's way out of the money and
exactly. And like I said, just a lottery ticket,
exactly.
Not putting
I'd
10%.
probably wait until, because probably what's going to happen is the thing will just trade sideways for a while. The ball will get sucked out of it, and you'll be able to buy it a lot cheaper, in the future.
Yeah, no, good thought.
I guess what I would recommend is seeing if you could find any back information on Tiffany, because that's the most recent one that was scrutinized, and of course we saw that one fall out of bed. But it's hard. I've always found it difficult to find old options data when the contracts have already expired. So I don't know if anybody out there who is listening has some advice or has ever tried to do any type of back testing using old options data, but if you do, fire it on over to us, because I think that would be valuable. I've always been curious to where to find it. So have you ever done anything like that, Chart? Look for old options historical data?
I have not.
Yeah, it's always been something that's
I'm sure it's out there, and it's probably expensive.
Yes, I think that's the issue. So, all right.
That's the one I was thinking about, Jim, too, is Tiffany, where there was some M&A drama. But yeah, I mean, it's just basically a court battle now, I think. LVMH decided because of the pandemic that they didn't want to buy them anymore. I think tourism at their flagship, the flagship location in Manhattan, with no tourism going to New York right now, just like really kind of crushed the appeal, I guess, at least short term. But I think it's just going to be settled in courts now. But
right, and so I was curious to see what the option premiums looked like heading into that, and if they were, expanding maybe right before, maybe you could get some type of historical context and at least have some sense to get a time frame that you might be looking at. And if you have an objective where, okay, mid 2021, maybe you can at least put the timeline together with any reports, pair up what we have on the page as to what might have been in scrutiny, and then see how the options market reacted, because it's easy to go back and see what the underlying Tiffany stock did, but as far as the actual perspective from option prices,
I would also point out
look.
that the 1319 comment, for anybody listening who just wants background on the deal, looks like our site just published a piece on the Eaton Vance Morgan Stanley deal 1 minute ago.
All right. Well, maybe they're listening to us, as they should be. All right. So, gentlemen, if there's nothing else, I'm going to wrap things up here. And thank you all, because this was very, very informative. I'm sure I speak for everyone listening. A great big thank you to you guys. Thank you for your time. And if you have any other additional insight, any follow-ups, feel free. Jump right in. I'll leave you guys on the horn. And thank you for the time and all the information.
Yeah, take care, guys.
Thank you, Jim.
Thanks, guys. Thanks, Jim.
And the good news is that I did record this, and we will post this later this afternoon. So if you did miss it, there was a whole lot of content for you all. So it will be posted to the page probably, in an hour or two, but sometime before the close, I would suspect. So as it stands right now, we are trading right at the top of the opening range. We did come in and get very, very close to the highs throughout our conversation, and we're trading right at that opening range level again, 34.31. So market picked up a bid right at that 34.20 area, and it was good timing for where chart trader ended up taking some profit on his trade right at 34.20, right around that area anyway. And then the buyer stepped right in. So again, what do we know now? Well, that level did what it was supposed to do. It held tight, buyer stepped in, and now we have a formidable candle. Now, what that would mean, though, is that you would have trapped longs if we did break down through the 34.20 area. So definitely want to be on guard for that.